Welcome to another session of the My Solo 401k Financial YouTube weekly webinar. We're getting started here momentarily. If you're on YouTube, please like and subscribe as we do these sessions on a regular basis, that we can get notification. We also post videos every day on our YouTube channel, really from our community. So it's a great way to learn and to share the knowledge. All right, as you can see, our session today is another deep dive session regarding 2022 and 2023 solo 401k contributions, focused on Mega Backdoor Roth, specifically for self-employed businesses that are taxed as a sole proprietorship, a single member LLC, maybe someone whose business is taxed, they're acting as a 1099 independent contractor. So if you're on YouTube, you can post questions in the chat. We'll go through those questions after we go through the slides that we wanted to share. All right, the audio is working. Fantastic. So yes, please like and subscribe. We would certainly appreciate that. And that way you get notification of our daily videos. I would also encourage you to join our community, as we host Zoom calls every day in our community. Every day at 1 p.m. Pacific, 4 p.m. Eastern. You can also post questions 24/7 in our forums. So it's a great way to learn and to share the knowledge. So I just chatted over a link to the community. So the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So as far as the agenda, we're going to be talking about the contribution limits. We want to give a Secure Act 2.0 update as it relates to those contribution limits, go through different scenarios, examples, how to use our online calculator, the deadline, how to make contributions, how to report contributions, what is not a contribution. So we're going to cover some good ground today. Again, the focus of the presentation are sole proprietors, single member LLCs, where income is reported on Schedule C, like a 1099 independent contractor, and specifically focusing on Mega Backdoor Roth contributions. So what's the benefit of a Mega Backdoor Roth? Well, it'll allow someone to be able to contribute as much as $61,000 or even $67,500 if you're 50 or older, where the funds ultimately end up in a Roth Solo 401k. And that's for 2022. For 2023, the limits have gone up to $67,000 or even $73,500 if you're 50 or older. Of course, the benefits of having funds in a Roth account is that you have the potential for tax-free growth. So step one is going to be finding a Mega Backdoor Roth Solo 401k provider like us. So then you've got to qualify. So in order to be eligible to set up a solo 401k, you have to be self-employed with no full-time W-2 employees working for any business owned by you or a spouse, if any. Thank you so much for bringing the good questions. We'll go through the questions at the end. So as far as when you're looking for a provider, the provider needs to offer a plan that allows for voluntary after-tax contributions. And we'll show you as we go through the slides, the mechanics of making those Mega Backdoor Roth contributions. It starts with making voluntary after-tax contributions, and then a plan that allows for an in-service, either conversion to the Roth Solo 401k or transfer out of the Solo 401k to a Roth IRA. You'd also want to look for a provider that's going to help you with all the mechanics, right? You have to have separate sub-accounts, such as pre-tax, Roth, and voluntary after-tax accounts. You have to take care of the ongoing compliance support. Look for a provider that will handle that ongoing compliance support, such as the required 1099-R reporting. And we'll shed more light on these compliance steps as we go through the slides. But first of all, anytime you're talking about how much can you contribute to the solo 401k, it's important to understand that your ability to contribute is based on different factors. Number one is your income, because you can't save more than you earn. And your ability to contribute to the solo 401k is based off of your self-employment income. Number two is your age, because as we alluded to earlier, if you're 50 or older, you may be able to contribute additional funds, whether you participate in another retirement plan, like a 401k plan through a day job. And then, of course, the type of contribution that you're looking to make, whether that's employee or employer, whether that's pre-tax, Roth, or voluntary after tax. So, what is your self-employment income? Well, for a self-employed business that's taxed as a sole proprietorship, that's taxed as where the income is reported on Schedule C, because maybe you're a 1099 independent contractor, your ability to contribute to the plan is based off of your self-employment compensation, which is your net income reported on line 31 of Schedule C, less 1/2 of the self-employment tax. You're not able to consider W-2 wages from other sources like a day job. You're not able to consider investment income. It needs to be earned self-employment income. So in order to, again, calculate that self-employment compensation or that self-employment income, you start with line 31 of Schedule C, less 1/2 of the self-employment tax. Then you've got to consider, okay, well, what year am I looking to contribute for? So the overall limit for 2022 is $61,000 plus an additional $6,500 if you're 50 or older. For 2023, it's $66,000 or an additional $7,500 if you're 50 or older. What's the type of contribution that you want to make? So with the solo 401k, you really wear multiple hats. You're both the employee as well as the employer. So you could make both employee as well as employer contributions. Employee contributions may be applied as pre-tax, Roth, or voluntary after-tax. So Roth and pre-tax contributions, those are impacted by contributions, if any, that you make to another plan, like a day job 401k plan. Whereas voluntary after-tax contributions are not impacted by day job 401k plan contributions. Employer contributions, those have historically always been pre-tax contributions. Now, the Secure Act 2.0 does now allow for employer contributions to be made as a Roth contribution. But as you'll see when we get to this following slides, really there's no substantive advantage to make employer contributions as Roth contributions when you have a solo 401k plan like ours that allows for Mega Backdoor Roth contributions. And we'll explain why that would be in just a couple of slides here. So Roth contributions, again, they may be applied as employee, technically could be employer, but really there's no substantive advantage of making those employer contributions as Roth contributions. If you're making those Roth contributions as employee contributions, then that could also include the catch-up amount. Remember, if you're 50 or older and you set up the plan by the end of 2022, then you can make those catch-up contributions all the way up to $6,500, assuming that you have the self-employment compensation to justify it. For 2023, that catch-up contribution limit went up to $7,500. Again, assuming that you're 50 or older, you set up the plan by the end of 2023, and that you got the self-employment compensation to justify it. Lastly, if you have a plan like ours that allows for it, one may be able to make voluntary after-tax contributions. So technically, a voluntary after-tax contribution is a type of employee contribution, but unlike the pre-tax or Roth employee contribution, which is impacted by contributions that are made to a day job 401k plan, voluntary after-tax contributions are not impacted by contributions made to a day job plan. And that's really because the limit comes from a different section of the code. It comes from a 415C limit, which applies at the employer level. So that's a lot, and we're going to now go through this and break it down in terms of the different limits, and then we want to apply these different limits to different scenarios. So let's first start out with the pre-tax employee limit. How much can I contribute? Well, employee contributions, which are also referred to as salary deferrals, the limit is 100% of the self-employment compensation not to exceed $20,500 for 2022, plus an additional $6,500 if you're 50 or older. For 2023, the limit went up to $22,500 or an additional $7,500 if you're 50 or older. Now, of course, this is impacted by contributions made to another plan, like a day job plan. So one would need to reduce by any contributions made to another employer plan, unless the other plan is a 458 governmental plan. So those same salary deferrals, employee contributions could be contributed as Roth contributions. In that case, you would need to have a separate Roth Solo 401k sub-account, because those funds need to be kept in separate, segregated accounts. And so you can contribute 100% of your employee contributions as Roth contributions. You could contribute 100% as pre-tax contributions, or you could contribute a mixture of pre-tax and Roth. So now let's flip to the employer contributions. Remember, when you're self-employed, you're both the employee and the employer. So employer contributions are also referred to as profit-sharing contributions. So the limit is a 20% of your self-employment compensation. Remember, for someone whose self-employed business is taxed as a sole proprietor, single member LLC, or a 1099 independent contractor, your self-employment compensation is line 31 of Schedule C, less 1/2 of the self-employment tax. Now, you also have to consider the overall limit. So all of the contributions, the aggregate contributions that are made to the solo 401k, right? The employee, the employer, can't exceed the lesser of your self-employment compensation or the overall limit, right? $61,000 for 2022 or $67,500 if you're 50 or older. For 2023, $66,000 or $73,500 if you're 50 or older. So unlike with the employee contributions, where that limit applies at the employee level, the employer contribution limit applies at the employer level. So it's not impacted by contributions made to another plan, like the day job 401k plan scenario, unless those other contributions are made to a 403b. So you've got the 403b exception to that general rule that employer contributions to a solo 401k are not impacted by contributions made to another retirement plan through an unrelated employer. So what changed with Secure Act 2.0 is now these employer contributions, these non-elective contributions, may be made as a Roth contribution. But like I mentioned before, for a solo 401k plan that allows for Mega Backdoor Roth Solo 401k contributions, this change offers no substantive advantage. So why would that be? Well, 3 reasons. Voluntary after-tax contributions can be contributed at a higher percentage of self-employment income. So you can get there faster because you can contribute 100% dollar for dollar of your self-employment compensation as a voluntary after-tax contribution, which can then be transferred to the Roth Solo 401k. If you have a plan like ours that allows for the voluntary after-tax contribution and plus the in-plan conversion, compared to making employer contributions as a Roth contribution where you're limited to a percentage, right? We just saw the limit is 20% of your self-employment compensation. So you'd get there slower. So voluntary after-tax contributions are presented advantage because you can get there faster. They're equal between the two, right? Making those contributions as a Mega Backdoor Roth contribution versus making those Roth contributions as an employer contribution. The deadline is the same, right? It's the business tax return deadline, including any timely filed extension. And as a matter of fact, you could even still set up a plan and make contributions for 2022, both the employer and the voluntary after-tax contribution, as long as you set up the plan and make those contributions by the business tax return deadline for 2022, including any timely filed extension. It's too late if you haven't already set up a plan for 2022 to set up a plan for 2022 now and make employee contributions, but you could still make both the employer or the voluntary after tax. So from a deadline perspective, they're equal. Voluntary after tax contributions are more flexible than employer contributions. So voluntary after tax contributions may be transferred to a Roth IRA, whereas if one makes employer contributions to the solo 401k, they may not be transferred out of the solo 401k, such as to a Roth IRA, until a triggering event has been met, right? So for example, attaining at least age 59 and a half or more. So for all of the above reasons, again, making employer contributions as Roth contributions presents no substantive advantage for a plan like ours that allows for Mega Backdoor Roth Solo 401k contributions. So what are some FAQs with respect to these new Roth employer contributions? Do I need to deposit the employer Solo 401k contributions made as Roth Solo 401k contributions in a separate account? No, you don't. So if you're making both employee and employer contributions as Roth Solo 401k contributions, those contributions may be deposited into the same Roth Solo 401k sub account, right? Of course, you need a separate account for Roth Solo 401k funds versus pre-tax funds, but whether those Roth contributions were made on as employee or employer contribution, they may be made into the same bank or brokerage account. What is the contribution limit for employer Solo 401k contributions made as Roth Solo 401k contributions? Well, it's what we just went through, right? It's 20% of the self-employment compensation. So it's a percentage. How do I report employer Solo 401k contributions made as Roth Solo 401k contributions on my personal or business tax return? Well, the law was just passed, so there's no specific IRS guidance yet on how to report these employer contributions made as Roth contributions. But it would be suffice it to say that it would not be prudent to report such contributions as deductible expenses, since these contributions are made on a Roth or a post-tax basis. So now let's finish going through the contribution limits, and then we'll talk about the scenarios. We'll apply what we've learned to different scenarios. So what's the voluntary after-tax Solo 401k contribution limit, right? Voluntary after-tax Solo 401k contributions are how one makes Mega Backdoor Roth contributions. So the voluntary after-tax limit is the lesser of self-employment compensation and the overall limit. So you're able to contribute 100% of your self-employment compensation, dollar for dollar, all the way up to the overall limit. Remember, that's $61,000 for 2022 or $66,000 for 2023. Now, of course, you have to reduce how much you can contribute as a voluntary after-tax Solo 401k contribution by any other contributions that you've made to the Solo 401k, right? If you also made employee or employer contributions, you'd have to aggregate so that you don't go over the overall limit. Now, what's interesting is you can ignore the catch-up though, right? So if you made a catch-up contribution to the Solo 401k because you're 50 or older, you don't have to reduce how much you can contribute as a voluntary after-tax contribution, but the voluntary after-tax limit doesn't go up. So effectively, you can get to the same place, right? If, for example, for 2023, if you're 50 or older and you have the self-employment compensation to justify it, you could go up to the $73,500 limit. And we'll show some examples to illustrate this point. What's also interesting is that although the voluntary after-tax contribution is considered to be a type of employee contribution, it's not impacted by contributions made to another plan, like a day job 401k plan, unless that other plan is a 403b. Voluntary after-tax contributions also need to be deposited into a separate sub-account for each participant. This is how you end up with having a pre-tax, a Roth, a voluntary after-tax sub-account. So 3 different sub-accounts for each participant, maybe 6, right? If you have both the husband and wife, for example, that are both working in the same self-employed business, both participating in the same Solo 401k plan. So now let's turn and apply what we've learned here to different contribution scenarios. So we're going to start out with our base scenario and go through the different assumptions. So here we're going to assume we've got a self-employed business that's taxed as a sole proprietor, single member LLC, maybe a 1099 independent contractor, right, where the income is reported on Schedule C. Let's assume it's just one participant who's under 50 years of age, does not make contributions to another plan. And let's presume that the goal here is to first maximize pre-tax contributions, and then to the extent that they're able, make any additional contributions as Roth and or voluntary after-tax solo 401k contributions. Finally, let's assume that the person has $100,000 of self-employment compensation. In other words, after they did that initial pre-calculation, line 31 of Schedule C, less 1/2 of self-employment tax, let's say the result of that pre-tax calculation is $100,000. And then finally, we're going to assume that all the employer contributions are made as pre-tax contributions, because again, making employer contributions as Roth contributions offers no substantive advantage over just making those contributions as Mega Backdoor Roth Solo 401k contributions. So with the base contribution scenario, what are the limits? So this person, because again, their goal is to first maximize the pre-tax, they would make that employee contribution as a pre-tax contribution. They're able to contribute 100% of their self-employment compensation, dollar for dollar, all the way up to $20,500 for 2022 or $22,500 for 2023. They're going to make that employer pre-tax contribution. Again, they're trying to first maximize the pre-tax benefit. That employer pre-tax contribution limit is 20%, so $20,000, 20% of their self-employment compensation. And then they'll make the difference as a voluntary after-tax contribution all the way up to the overall limit, $20,500 for 2022, $23,500 for 2023. So now let's change the base assumption. Instead of $100,000 of self-employment compensation, let's assume they have $50,000. So what changes? Well, they're still going to be able to hit that $20,500 pre-tax employee contribution limit for 2022 and $22,500 employee pre-tax contribution limit for 2023. Their employer limit will come down because remember, that's a percentage, it's 20%. So now 20% of $50,000 is $10,000. And now they can do the difference, but here they can't contribute more than they earn. So the total amount of contributions that are made to the plan cannot exceed the $50,000 in self-employment compensation. So that means that as a voluntary after-tax contribution, they're going to be able to contribute $19,500 for 2022 and $17,500 for 2023. So now let's go back to the base, again, back to now having $100,000 of self-employment compensation, but let's assume that this individual maxes out contributions to a day job plan, right? They contribute $20,500 for 2022 to their day job plan and $22,500 for 2023 to their day job 401k plan. So how do the contribution limits change? Well, that employee limit applies at the employee level. So this person already maxed out their contributions to their day job plan. So they're not going to be able to make any more employee contributions to the solo 401k. The employer limit, the voluntary after-tax limit, applies at the plan level, at the employer level. At the employer level. So the fact that the individual made contributions to a plan sponsored by an unrelated employer, their daytime job 401k plan, doesn't reduce how much they can contribute to the solo 401k. So again, their goal is to first maximize pre-tax. So they're going to make a $20,000 employer pre-tax contribution and then just contribute the difference as a voluntary after-tax contribution. So the difference is $41,000 for 2022, $46,000 for 2023, and then move that money from the after-tax account to either their Roth Solo 401k or Roth IRA. So now let's go back to the base. Here, this person doesn't make contributions to another plan, $100,000 of self-employment compensation, but now the goal is to not make pre-tax contributions, but just focus on Roth and or voluntary after-tax contributions. So how do the contribution limits change? So they're still going to make the same amount of employee contributions, right? 100% of their self-employment compensation. So for 2022, that's going to mean $20,500 as an employee contribution. For 2023, $22,500. But instead of making that employee contribution as a pre-tax contribution, they'll make it as a Roth contribution. They're going to skip making the employer pre-tax contribution because they're not interested in making pre-tax contributions, and then just make the difference, right? All the way up to the overall limit, $40,500 for 2022, $43,500 for 2023 as a voluntary after-tax contribution, and then move it to the Roth account, right? So at the end of the day, for 2022, they'll have made $61,000 in contributions that'll end up in their Roth Solo 401k sub account, and $66,000 for 2023 that'll end up in their Roth Solo 401k sub account, where they've got the potential for tax-free growth. So now let's go back to the base, and let's assume that there's two participants, right? Each person makes $100,000 in self-employment compensation. So what changes? Well, nothing changes in terms of the amount of contributions. What this simply highlights is that each person is able to make those contributions. And since we're assuming that each person is in the same, has the same scenario, right? Each person is under 50. Each person has $100,000 of self-employment compensation. So for example, each person has their own Schedule C where they have enough self-employment compensation that after reducing by 1/2 of the self-employment tax, each person is reporting $100,000 of self-employment compensation. So each person would contribute $20,500 as a pre-tax employee for 2022. Each person would contribute another $20,000 as an employer pre-tax contribution. And then each person would contribute the difference as a voluntary after-tax contribution. So this just highlights that the ability for someone to contribute to the plan is based on their own situation. Hopefully that helps. So now let's go back to the base. Now we're back to the one-person scenario, $100,000 of self-employment compensation. The goal is to first maximize the pre-tax contributions before they make any Roth and or voluntary after-tax contributions. But let's assume that this person's 50 or older. So what changes? Well, what changes is that they're able to make the catch-up contribution. So that this highlights how the catch-up contribution is made as an employee contribution. So that would be an additional pre-tax employee contribution, because again, the goal of this person is to first maximize the pre-tax benefit. So they're going to be able to contribute 100% of their self-employment compensation, dollar for dollar, up to $20,500 for 2022, plus an additional $6,500 for 2022 as a catch-up employee pre-tax contribution. For 2023, they're going to be able to contribute 100% of their self-employment compensation, dollar for dollar, up to $22,500, plus an additional $7,500. So now they've made $30,000 in pre-tax employee contributions. The other contribution buckets, the employer, the after-tax, doesn't change. So really what changes with that person being 50 or older is that they're able to contribute the catch-up contribution amount. So now let's go back to the base. One person under 50, $100,000 of self-employment compensation. Here, though, they have maxed out the contributions to their day job plan, and they're not interested in making pre-tax contributions. They want to focus on Roth or voluntary after-tax. So since they maxed out the contributions to their day job plan, they're not able to make any more employee contributions to the solo 401k. They're not interested in making employer contributions as a pre-tax contribution. So they just simply make 100% all the way up to the overall limit, since they have $100,000 of self-employment compensation as a voluntary after-tax contribution. So that means $61,000 for 2022, $66,000 for 2023, which can then be transferred over to either their Roth Solo 401k or Roth IRA. So now let's go back to the base. Now let's assume this person's 50 or older. Again, they max out the contributions to the day job plan. And again, they're not interested in making pre-tax contributions. So what changes? So nothing changes. So what this highlights, again, they're not able to make employee contributions because they already maxed out to the day job. They're not interested in making pre-tax employer contributions. So they just simply make it all as a voluntary after-tax contribution. So even though they're over 50, that voluntary after-tax contribution limit doesn't go up because you're over 50. So that's what this slide helps to highlight, this scenario. So now let's go back to the base. It's 2 participants instead of 1, but each person maxes out contributions to the day job. Each person has $100,000 of self-employment compensation, so they each have their own Schedule C that reports that sufficient income to result in $100,000 of self-employment compensation. And each person is only interested in a Roth and voluntary after-tax. So since they maxed out to the day job, they can't make any more employee contributions to the solo 401k. They're not interested in making employer pre-tax contributions, and they just make 100% of their self-employment compensation as a voluntary after-tax contribution, dollar for dollar, all the way up to the overall limit, $61,000 for 2022, $66,000 for 2023. So what this highlights is that each person is able to contribute this amount because each person has the self-employment compensation to justify it. So hopefully those scenarios help to shed light on how these contribution rules work. So now I know we've got some good questions, so we'll turn to those here as we get to the end of the slide shortly. So we want to just finish up with some more mechanics of making the contributions, how to report the contributions, what is not a contribution. So you can make contributions either by check, by electronic transfer. If you're going to make the contributions as electronic transfer, I mean, either is acceptable from a solo 401k perspective, but just practically, of course, you want to check with the financial institution that holds the account for your solo 401k into which you want to deposit the contribution. So for example, we help many, many clients open up accounts at different brokerages like Fidelity, Schwab, TD Ameritrade, just to name a few. And the general rule is that the brokerages don't allow for electronic deposit from an external account where the name on the external account is not in the name of the plan. So if you're trying to deposit, for example, from your business account or your personal account, they won't allow it. The one exception to that general rule is Fidelity, that does allow for an electronic deposit into the brokerage account at Fidelity from an external account where the name on the external account doesn't match the name on the account of Fidelity. Of course, the name on the account of Fidelity is going to be in the name of your plan. So for example, if you're trying to make an electronic deposit from your personal account or your business account to fund these contributions, if you've got different participants, each participant is going to have their own separate sub-account. And then if each participant has different types of funds, right, pre-tax, Roth, voluntary after-tax, again, you've got to have different sub-accounts for each of those different types of funds. What is the deadline to make contributions? Well, per IRS Publication 560, which is the landmark guidance for self-employed retirement plans like a solo 401k, the deadline for plans that were set up by the end of the year, so for 2022, as long as you signed up with us before December 31st, under IRS Publication 560, now you've preserved the right to make all types of contributions anytime up until the business tax return deadline, including any timely filed extension. So we got a good chart here that lays out the 2022 deadlines for those plans that were set up by the end of the year. So again, you would have preserved the right to make contributions all the way up until the business tax return deadline, including any timely filed extension, all types. So for a business taxed as a sole proprietorship, right, or an LLC taxed as a sole proprietorship, that's really the 1040 deadline. So April 17th, or if a timely extension is filed, October 16th of this year. Now for 2023, as long as you sign up with us before the end of the year, now you'll preserve the right to make 2023 contributions all the way up until the business tax return deadline, including any timely filed extension next year in 2024. So for a business that's taxed as a sole proprietorship, a single member LLC, where income was reported on Schedule C, that's again really the 1040 deadline. So that's April 15th or October 15th if you file a timely extension of 2024. How do I report contributions? Well, it depends on the type of contribution that you're referring to. If it's a pre-tax employee contribution or a pre-tax employer contribution, in either case, those contributions are reported on line 16 of Schedule 1 of the 1040. Roth contributions, voluntary after-tax contributions for a business that is taxed as a sole proprietorship, right, where the income reported on Schedule C of the 1040, those types of contributions are not reportable. Now, it's noteworthy that voluntary after-tax contributions are going to be indirectly reported on the Form 1099-R, but it's really not the contribution that's being reported. It's the subsequent transfer from the voluntary after-tax Solo 401k subaccount to either the Roth Solo 401k subaccount or the Roth IRA. So how do I convert after-tax to Roth? Well, you can transfer by check. You can transfer electronically, right? ACH or wire. Transfer between bank and or brokerage account. As part of our onboarding process, we're going to help our clients open up the requisite number of accounts at the bank or brokerage of their choice. Those funds could either go to a Roth Solo 401k or Roth IRA. So with the next few slides, we wanted to highlight the process for different brokerages, and you'll see a pattern, right? So we'll start with Fidelity. So step one would be to make the contribution. So you need to have an account at Fidelity, which again, we help our clients open up accounts at the bank or brokerage of their choice. It's got to be a separate voluntary after-tax Solo 401k sub-account. The contribution is made to the account at Fidelity, of course, within the limits, by the deadlines, all the things that we went through. Then the funds are converted to a Roth. So one option would be to convert to a Roth Solo 401k. That could be another brokerage account at Fidelity for your Roth Solo 401k, or to a Roth IRA. It could be a Roth IRA at Fidelity or even a different institution. In either case, the transfer from the after-tax to the Roth is reportable. And clients let us know via online forms. We have one form if it's an after-tax to Roth Solo 401k, a different form if it's an after-tax to Roth IRA. TD Ameritrade, very similar process, right? We're helping clients open up a brokerage account at TD, make the contribution, convert to Roth, tell us about the information that's needed so that we can put the plan in the queue to be able to prepare the 1099-R. Likewise with Schwab, right? We help our clients open up the brokerage account at Schwab, specifically for the voluntary after-tax Solo 401k contribution. Contribution is made, and then funds are transferred with a click of a mouse from the brokerage account at Schwab. Could go to either a Roth Solo 401k or Roth IRA, and then let us know about that conversion so that we can put your plan in the queue to prepare that 1099-R. We handle preparation and submission of the 1099-R as part of our service for no additional charge. And so now the question becomes, okay, should I convert to a Roth IRA or Roth Solo 401k? That's a great question. And once the funds are in that voluntary after-tax account, you can go either way. There's no triggering event. Some of the considerations are, if you want to be able to preserve the right to take a 401k loan, then you need to keep the money in the 401k. So that would mean Roth Solo 401k. So our Roth Solo 401k plan, for example, allows for a 401k participant loan. We handle the preparation of the loan documents as part of our service for no additional charge. Whereas if the funds went out to a Roth IRA, you can never take a loan from an IRA, including a Roth IRA. If the individual wants to preserve the ability to invest in alternative investments, right? It's much easier to invest in alternative investments with checkbook control with our Roth Solo 401k account versus a Roth IRA, right? With a Roth IRA, you'd have to have an LLC underneath that Roth IRA, the expense of that LLC in order to have checkbook control over the money, right? So with respect to a Roth IRA, what draws some people to transfer the funds from the voluntary after-tax account to the Roth IRA, it varies, but it could be because with a Roth IRA, you can take funds out without having to meet a triggering event, right? With respect to a Roth Solo 401k, right? Like we talked about with the new employer contributions being able to be made as a Roth contribution, before one can transfer funds out of the Roth Solo 401k account, they have to meet a triggering event. For example, attaining age 59 and a half or older. Whereas with a Roth IRA, funds can be taken out of that Roth IRA without having to meet a triggering event, right? First, you got to there's ordering rules, right? You have to take out contributions, et cetera, before you ultimately get to the gains. Roth IRAs are not subject to require minimum distributions, whereas Roth Solo 401k plans are subject to required minimum distributions. Now, what's interesting about that is that what folks who are approaching the age when they have to take a required minimum distribution will often do is just simply transfer the funds out of their Roth Solo 401k to a Roth IRA before the end of the year so that there's no required minimum distribution amount. But those are some of the top considerations as far as whether to transfer the funds to a Roth IRA or Roth Solo 401k. There's no deadline to convert voluntary after-tax Solo 401k funds. So there's a deadline to make the contribution, but the subsequent transfer to either the Roth Solo 401k or Roth IRA, there's no deadline, and it's reportable for the year of the conversion. For example, we have many clients who sign up by the end of the year, say 2022, and now they're making those 2022 contributions anytime up until their business tax return deadline, including any timely filed extension. So they might be making 2022 contributions in the calendar year 2023, which of course means when they make that subsequent transfer to either the Roth Solo 401k or Roth IRA, that could very well likely be in 2023. That would be in 2023. So if the funds are converted in 2023, then the 1099-R will not be issued until 2024. Then that's fine. Tax reporting. So when those funds are transferred from the after-tax account to either the Roth Solo 401k or Roth IRA, that transfer is reportable again on the 1099-R, and then of course again on the on your 1040, right? So you'd work with your tax advisor to give them that information. So it's listed on line 5A, and then to the extent that the amount converted is listed on line 5A of the 1040, or any gains on line 5B. Again, we have online forms that clients use to let us know about those transfers, those conversions, so we can put your plan in the queue to be able to prepare that 1099-R. So with the last few slides, we wanted to give some illustrations of how the different account setup might look. So with this illustration here, we have a one participant Solo 401k where the person has both pre-tax, Roth, as well as voluntary after-tax Solo 401k funds. So they end up with three different sub-accounts, right? It could be three different accounts at Fidelity, three different accounts at a bank, three different accounts at Schwab, whatever their choice is. With a two-person scenario, now you got six accounts, right? You got Jane Doe that has pre-tax, Roth, and after-tax, John Doe that has pre-tax, Roth, and after-tax, for a total of six. And then in this last illustration here, this person is transferring the funds out of the Solo 401k to a Roth IRA. So if they don't have any Roth Solo 401k funds, they could just have two accounts for the Solo 401k, say pre-tax and after-tax, and then transfer the funds out to their Roth IRA. So that takes us to the end of the slides. Thank you so much for participating and listening. We do appreciate it. Please like and subscribe as we host these type of deep dive sessions on a regular basis on our YouTube channel. You can also get notifications of our daily videos that we post, as we post good questions that really come out of our daily Zoom calls on our community. You're able to join those, all are welcome. It's totally free to join at mysolo401k.net/my community. We also have 24/7 forums. So it's a great way to learn and to share the knowledge. So let's go to some of the questions. I have a Solo 401k set up through your company. What do I need to do to set up the Mega Backdoor? So great question. Let me pull up a page on our website. 1 second here. Of course, the plan documents, because that's one of the top reasons that clients set up accounts with us, are automatically going to allow for making Mega Backdoor Roth contributions. So if you don't have the requisite accounts, it's just a matter of us helping you open up the accounts that are needed at the bank or brokerage of choice. So I'm chatting over a page on our website that's a good resource, and you could just follow those steps there. There's links to be able to let us know, to prompt us to prepare the paperwork to open up accounts at the bank or brokerage of choice. There's a link to the 1099-R form. So hopefully that helps. Thank you for bringing the good question. On opening the LLC, 401k as the sole owner, is that something you assist with, or do I have my attorney create it? We do as a customer accommodation. Of course, you're free to have your attorney do it also. Let me chat over some links on that one. One second. Okay, thank you for your patience. Here's more information about that process. And it looks like there's a question there, like more of an account type question. If you could please send an email to info@mysolo401k.net, and we can check on the status there. Thank you for participating and bringing the good question. Is there a limit to how often you can amend a solo 401k plan to another custodian? Can I amend solo 401k documents to my solo 401k if I've already contributed to the plan? No, there is no limit. And yes, you can certainly do that. That's one of the top reasons that clients set up accounts with us. Let me see if I can pull up a good resource for you quickly. Here it is. There's a good page on our website. We've got a infograph, a video webinar talking about the process to change a solo 401k at E-Trade to our plan to take advantage of some of the service and features that our plan offers. So I chatted that over. So thank you so much. I don't see any more questions. We'll give it a minute in case there's any final questions. So again, just to highlight the resources, we've got our community where we host Zoom calls on a daily basis. We host forums 24/7. We post good videos every day out of those Zoom calls on this YouTube channel. So please like and subscribe. Please continue to engage as we share information, every day. So absolutely. So it could be a former employer plan, right? So number one, if you're eligible to set up a solo 401k, you can certainly transfer funds from a former employer plan. If you already have a solo 401k plan, then it's a matter of just restating the plan with us. So that's, we have clients that bring their existing plan to us every day, to take advantage of our service, our features, right? Like Mega Backdoor Roth, the ability to invest in alternative investments, the ability to take a loan, the fact that we, this 5500 EZ, preparation and submission, the 1099-R, preparation and submission as part of the service for no additional charge, just to give some common reasons why people get started with us. Thank you so much for bringing the good question. I chatted over a link about restating the plan generally. I already have a solo 401k with another company. Can I start a new one with my company and not contribute to my old solo 401k? Good question. So really, we have a lot of folks that are maybe serial entrepreneurs. They've got multiple businesses. In that case, it's not a good idea to have multiple plans. That could be an audit red flag. Instead, you could restate an existing solo 401k plan to our plan, though, to take advantage of the service and features that we offer. So hopefully that helps. All right. Well, thank you so much, everyone. Thanks for all the great engagement, great participation. Please continue to participate. Looks like that takes us to the end of the questions today. Thank you so much. All right, all the best. Take care.